And welcome back, options traders. Good morning, everyone. Well, a decision that traders are faced with a lot these days is what should I do when volatility spikes? Because if we have this big spike in volatility, it's going to increase our option prices, and that actually poses a dilemma. And so sometimes traders say, well, it's a good thing because maybe I can make more money, but it's also a negative because we might lose it all. So to understand the decision-making process, let's dig a little deeper and find out why increased volatility actually benefits your long options. So when it comes to options, increased volatility increases all option prices. When I say all, I'm talking about the long positions, so the long calls and the long puts. If you're short these options, then they're going to go against you. It's going to harm the position. So the idea to understand is that if we get an increase in volatility, option prices, those prices that you see on the quote boards, are all going to increase. Now this little fact throws new traders because normally volatility is associated with risk. If we have more volatility in the market, we have more uncertainty. Prices are bouncing around a lot higher and a lot lower. Well, that's risk. And higher risk usually means lower prices. Well, that's true for the stock market and actually a lot of different markets, but it's not true for the options market. This is one of the many benefits we get as options traders. So the first question that we have to address is, why is this opposite for options? Why does increased volatility actually help us? Well, understand that when we talk about volatility, we're saying that there is a range of potential stock prices. And yeah, there's a mathematical formula for it, and it's really the standard deviation, which we could graphically represent with a bell curve. So visually, for any stock price, you can think of a bell curve as sitting directly over the current stock price. So let's say that this red curve represents 20% volatility, and the current stock price is right here at 100. Well, what happens if the volatility increases? Maybe it goes from 20 to 30 or 40. The number's going up. What's going to happen is that this curve is going to get shorter and wider. And what that means is that we now have the potential for higher stock prices, and we have the potential for lower stock prices. Well, the higher stock prices benefit the call options, and the lower stock prices benefit the puts. So this is a good visual of why all of our options, all calls and puts, will increase in value if we get a spike in volatility. So to help you see why, let's take a look at a call option. So right here at this bend is our strike. This is a $100 call. And let's say that we have that same bell curve sitting directly over the current stock price. Well, now volatility spikes. We get this bell curve that's now shorter and wider. And yes, that means we could potentially have much higher stock prices, and we could potentially have much lower stock prices. So again, if we were holding shares of stock, this would be bad. The higher volatility cancels out. Yeah, it can benefit us, but it can also harm us in equal proportions. But notice that that's not true for options. With the higher volatility, we have the ability for the stock price to make higher gains, but that's good for us because with this call option, we have unlimited potential gains. But notice that the increased potential for downside doesn't hurt us. We have a fixed maximum loss. Once we paid for that option, that was our maximum loss no matter what happens to volatility. So the best way to understand it is that when volatility increases, it might help your positions, but it cannot hurt them. And that's why all of your options will benefit from increased volatility. So as an options trader, what should you do if you're faced with a sudden spike in volatility? So for instance, let's say that we have a stock trading for 100, there's 90 days to expiration, interest rate's 1%, and volatility is 20%. And if you throw these numbers into a pricing model, you'll find that the $100 call will be trading for about $4. Well, what's going to happen if volatility spikes to 60%? Just go into that same pricing model, change the volatility from 20 to 60. And now you're going to find that that $100 call is trading for 12. I've given the volatility a boost by a factor of 3, and it's therefore increased my option price by a factor of 3. So it was trading for 4 and now it's 12. So yes, that certainly looks like a good thing. We're seeing our option price increase, but it does pose a dilemma. And here's what you have to consider. Remember that all extrinsic value will be zero at expiration. So if we paid $4 for that option and that stock price is 100 or lower at expiration, we lose 4. But under the higher volatility, if that same stock is at 100 or lower, now we could potentially lose 12. It's just pure air or fluff in the option. That's why it's called extrinsic value. There's no intrinsic value behind that or backing it. So the thing that you have to understand as a trader is that you must decide if the increased gain from volatility is worth risking for more potential profit. So if you continue to hold that option, might be a great decision. Maybe that stock's on its way to 150. But if you hold it, you're going to look back and regret it and say, gee, I paid 4, I could have sold it for 12, and now I ended up with nothing. So remember, a really good decision or a good tactic whenever you're faced with dilemmas like this is to close half and hold half. So if you have 10 contracts, maybe shut 5 of them down, just sell them to close, and hold the remaining 5. And at least you've got something to show for it. What else could you do? You could close half and roll half. Get a bigger profit, guaranteed profit in your pocket, but continue to hold out for higher upside. But in order to use these tactics, you have to understand your option theory and your strategies. But hopefully that gives you some things to consider for these volatile markets. So for anyone who'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a brand new technical analysis course. It's all at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.